After understanding Haradomar model, investment is the key towards development. Sam thought of implementing this principle in his business. Sam then sat on his desk at his construction office in the morning, reviewing plans for a new construction project. He looked stressed and overwhelmed. Sarah, his business partner, more conservative and risk-averse, walks in with a coffee in hand.
Morning, Sam. You've been up all night working on these plans again, haven't you?
Yeah, it's just, we've got a big project lined up but the market's uncertain. Interest rates are rising, and I'm not sure if it's the right time to take on more debt. Every investment decision feels like a gamble right now.
Yeah, I hear you. The economy's all over the place. With the interest rates climbing, borrowing money is getting more expensive. It's scary, Sam. Maybe we should hold off on expansion for now.
But Sarah, this could be our chance to grow. I mean, what if the government comes in with some new infrastructure spending? The market might pick up again, and we could miss out on huge opportunities. But I don't know. The risk feels huge.
That's the thing. If we get too aggressive, we could end up in deep trouble if the economy takes a downturn.
Sam is on site at one of the current construction projects in the afternoon. Emma, his financial advisor, walks up to him with a folder.
Hey, Sam. I wanted to talk through some of the financials with you. I know things feel uncertain, but I think we need to look at the bigger picture. You're not just thinking about the next quarter, you need to think about the future.
Emma, I'm just not sure if we should make a big move right now. With interest rates rising, the cost of borrowing is through the roof. How do we even make this work?
Okay, but think about it like this, interest rates do affect your business, yes, but investment decisions aren't just about the cost of borrowing. It's also about expectations. Do you remember the last boom in construction? Interest rates were low then, right?
Yeah, I remember. We had some of the best years.
Exactly. But here's the thing about the Keynesian model of investment, it's not just about what's happening right now, it's about future expectations. Let me explain it a little deeper. According to Keynes, businesses don't just make investment decisions based on current interest rates or past profits. Investment decisions are largely based on future expectations, what businesses expect to happen in the economy tomorrow or in the next few years.
So you're saying we should make a decision today based on how we think the economy will perform, even if we don't know what will happen?
Exactly. And Keynes explains this with the idea of the marginal efficiency of capital MEC. You know, businesses decide to invest based on the expected return on new capital. If the expected return MEC is greater than the cost of borrowing, that is the interest rate, then it makes sense for a business to go ahead and make that investment.
Okay, I think I get that part, but isn't it risky? I mean, if interest rates are so high, we might end up paying more for borrowing than we make in profit, right?
It's a valid concern. But here's where the concept of marginal efficiency of capital MEC comes into play. The MEC represents the expected rate of return on an additional unit of investment. If this expected return is higher than the cost of borrowing, which is the interest rate, then investing is worthwhile. Let me give you a formula for clarity. Investment occurs if MEC is greater than interest rate. This formula means that if the expected return MEC from an investment is greater than the cost of borrowing, businesses will go ahead and invest. For example, if the MEC is 8% and the interest rate is 5%, it makes sense to borrow and invest because you're getting more return than what you're paying in interest.
But that still seems risky, especially if the MEC isn't as high as it should be. What if the market turns bad? What if the return on the investment doesn't meet our expectations?
That's where uncertainty and animal spirits come in. You see, Keynes didn't think investment was purely rational. There's always a level of uncertainty. Businesses never know for sure what the future holds. This is where the idea of animal spirits comes into play. It's a bit of a psychological factor. Animal spirits refer to the emotions and confidence that drive investment decisions. Sometimes, businesses decide to invest because they feel optimistic about the future, even if the hard numbers don't seem to support it.
So, it's not just about the cold, hard numbers, it's also about our gut feeling. If we feel the economy is going to grow and demand will increase, we might invest based on that belief.
Exactly. Expectations are critical. Expectations of future demand, future profits, and overall economic conditions influence the level of investment. This is why during times of uncertainty, businesses can hold back from investing. If business confidence drops, even if the interest rate is low, businesses may not invest because they feel pessimistic about the future. That's why animal spirits play such an important role.
So, it's not just about whether the cost of borrowing is high or low. It's also about how we feel about the economy.
Yes. And this is where government intervention can play a huge role. When there's a downturn, and businesses are hesitant to invest because of low confidence, the government can step in and stimulate demand through fiscal policy, like increasing government spending on public infrastructure projects. This helps to boost overall confidence in the economy, encouraging businesses to invest. For example, if the government builds new roads, bridges, or schools, construction companies like yours will get contracts. This increased public investment will encourage private investment, even in uncertain times. This is known as the crowding-in effect.
So, the government can actually encourage us to invest by spending money on projects, even if the market isn't doing well?
Exactly. When the government spends money on public works, it creates jobs, demand, and helps boost the overall economy. And when the economy picks up, businesses like yours are more likely to invest, creating a multiplier effect. Let me explain the investment multiplier to you.
Thanks for watching. Don't forget to like, subscribe, and hit the bell for more economics explained in a fun and easy way.